Hello and welcome everyone. Great to have you back again for our third and final chapter of this series that we put on together. And we are excited to have you. We hope that you will take some notes. You'll get some value from being here. Thank you for the investment of time. Thank you for your commitment to this three-part series. I'm glad that we're together today. Right after you'll have some time to reflect, but it's going to be fun. Please take some notes. We're going to move fast and keep up with us. And we're just excited to be with you. So my name is Lester Barron, and it's an honor and a pleasure to be partnered with us and New Vision to be bringing you this amazing series. And I'll tell you right now that there are very few companies doing what New Vision is doing, especially in this time where a scholarship is available to you on this call. So if you could and if you would, please go to essaychallenge.com to look at what the scholarship entails, look at what it takes to apply, look at the amazing details in there so that you can qualify. But we hope to give away all of this money together. And so we hope that you will be the person to be the beneficiary of these funds. We have Kirsten Barron, who's my lovely wife, who's going to be speaking first. And so what we'd like for you to do before I introduce Kirsten is engage with us. Please type your questions in the chat. Please give feedback, thoughts, comments, perspective, opinions, reactions to anything that we say. And just engage, because the more you engage today, the more fun it's going to be, the more exciting it's going to be, and the more likely you are probably to get the scholarship. Well, as I introduce Kirsten, let me share something with you. It is said that an expert puts in 10,000 hours into their craft. Now, what I can tell you is Kirsten being my wife, she's been with our firm for nearly a decade, and she's put in so many hours into the field. She does seminars all over. She speaks all over Zoom. She speaks from coast to coast now because of Zoom. And it's an honor and a pleasure to see her in the vein that she serves. She came not from a financial background, and has probably been exactly where you are, and she's very relatable. But I'll tell you, the information that she's going to give you today is going to knock your socks off. So please strap on your seatbelts, put your helmets on, get ready to have some fun, take some notes, listen, follow along, and help me welcome my beautiful wife and my business partner, Mrs. Kirsten Barron. Kirsten, turn it over to you.
All right, awesome. Thank you so much, Lester, for that introduction. And it is great to be here with you guys again. If you have been to the previous webinars that we've done, welcome back. If this is your first time, welcome. So this is actually the last webinar we'll be doing in this series that we have had going on the past few weeks. And I hope that those of you who have been on the other webinars have gotten a lot of value. We really want to make this something that's easy to follow, but also very practical, things that you can implement in your real life. So today's topic is going to be about credit. And so there's a lot of questions that I get asked about, credit, understanding what are the best ways to build your credit, credit cards, just all those things. And, when you're first kind of starting out in the real world, or I should say, or, being an adult and having a full-time job and all those things, credit is one of those things that we're going to get introduced to, whether it's through mailing offers, the offers that you get in the mail that start pretty quickly once you turn 18, offering you to buy a credit card and different things like that. So, but it's really important that you're careful on not getting into where so many Americans see themselves, which is a ton of credit card debt, because again, it could lead to a lot of stress, a lot of financial problems. No one enjoys being in debt. If you were on one of our last webinars, I touched on the good uses of debt versus the bad uses of debt. And so, and I believe that one you're able to go look at it, it's recorded. But for today, we're going to be specifically focusing on credit cards. So, like Lester said, if this is your first time, I've been working in this industry now for about 9 years, almost 10 years. And I know when I first got started and, was kind of getting my financial plan together, there were a lot of things that I didn't know and that I wish someone had taught me sooner. And so if you are here on this webinar, I want to commend you, because you are learning things that literally I sit down with all kinds of people from all walks of life every day. And if you're getting this information and you're here, you're learning things again that a lot of people wish they had when they were younger as well. So it's going to be super valuable. And I saw that someone already posted a question about hard inquiries, and that's something we're actually going to touch on. So let me go ahead and jump into this and share my screen. Okay, awesome. So this is part 3. So these are the different things, again, that we're going to be covering today. And so we're going to be talking about good spending habits to establish good credit, the rule of 72. This was something that I talked about in the last webinar, but for this webinar, we're going to be talking about the rule of 72, specifically how it applies to credit card interest rates. And then we're also going to be talking about learning about credit card perks, rewards, and limits, credit inquiries, like the question that I saw pop up. And then also, lastly, we're going to be ending with the impact of taxes, which is kind of off topic for the credit card, topic that we have today, but we didn't get a chance to go into it before. So I did want to at least touch on that because I know that I get a lot of questions regarding taxes when it comes to saving money and investing and things like that. So that'll be the last thing that we touch with. So let's go ahead and get started with this. So when it comes to good spending habits to establish a credit card and building good credit, the rule of thumb is that you only want to borrow what you can afford. A credit card is not permission to buy things you can't afford. This is the quickest way to get into debt and credit trouble, okay? So what sometimes happens, especially when we're younger, but I see this happen with, again, people with all walks of life, is that you get a credit card, and what does that mean? All of a sudden now you have free money. You have a credit card where you can literally walk into, Macy's or walk into a restaurant or whatever it is, swipe your card, buy what you want, even if you don't have the cash. But this is where people get into trouble because they start using their credit cards to buy things that they actually can't afford, which is why they're putting it on the credit card, okay? So the best way, again, to build good credit is to create the habit of charging only what you can afford. So again, a credit card is not a permission slip to start buying things that you wouldn't have bought otherwise because you didn't have the cash. The second tip is use only a small amount of the credit you have available. Maxing out your credit cards or even coming close is irresponsible, particularly if you don't plan to pay the whole balance off within the month. Now, I sit down with families who utilize credit cards for different perks, which is one of the things we're going to touch on. And so, but what they do is they don't stay in credit card debt. They don't keep that debt revolving. At the end of the month, they pay off the entire balance because they only use it for what they can afford. So at the end of the month, they have a zero balance again. And then the next month, they'll use it to buy their things and then pay it off at the end of the month. So again, they're not sitting there building up a ton of credit card debt. Lenders know that borrowers who max out their credit cards often have difficulty repaying what they've borrowed. And again, this is something that can negatively affect your credit score. And then the third is let your accounts age. The longer you've had credit, the better it is for your credit score, and leave your oldest accounts open since they help increase your credit age and build good credit, okay? So let's keep going on with the tips. So here are 5 tips to eliminate and stay out of debt. So the first one we're going to touch on is know what you owe. Second is no more late payments. Third is target one debt at a time. Fourth is stop charging and cancel unused subscriptions. We live in an era of everything is subscriptions, monthly subscriptions. And then lastly, refinance your mortgage. So starting with the top one, so no more late payments. Paying after the due date hurts your credit score and occurs late fees. So if you have a credit card or some kind of debt that you're making monthly payments to, you want to make sure that you are making that payment on or before the due date. You don't want to wait till after. So here are 2 quick tips to make sure that you don't fall into that trap. The first one is sign up for automatic payments. Pretty much everything that you sign up for, anything that you're paying a monthly subscription on, or whether it's a debt or, your Netflix or whatever it is, your gym membership, you have an option for automatic payments. So it makes more sense to just set it up on automatic so you don't have to worry about keeping track of all the different due dates that you have. So I like to set things on automatic payments so I know it's getting paid on time. I know I'm not getting behind. I'm not going to be hit with any late fees and everything is getting paid, okay? Then the second one is set alarms on your phone. So if you don't have the option to set it up on automatic payment, or maybe there's other reasons why you don't want to do that, you utilize technology. So I'm the kind of person where I have to utilize technology or I'll forget things. So for me, I actually have a spreadsheet, and some of you guys were maybe like, whoa, but I actually have a spreadsheet where if I don't have something on automatic payments, I have a list of the things, the bills that I need to take care of each month. And then I have the due date organized, but then I also use my phone and put reminders on my phone if something is due, but I don't put the reminder on the due date. I'll probably put it like a couple days before, just to give me, some space. So these are just simple things that you can, again, practical tips that you could implement in your own life to make sure that you're staying on top of your responsibilities. So a good credit score can open opportunities to get lower interest rates on loans like mortgages. So one of the reasons why you want to have a good credit score, a good to excellent credit score, probably the biggest reason, especially here in California, is to buy a house. If your dream is to buy a house someday, that's really, in my opinion, I would say the number one reason why you want to have a good credit score. What that's going to allow you to do is be able to apply for a loan for a house, but then also get a lower interest rate. Because when you apply for a loan and you're paying that money back, you're not paying just what you borrowed. So if I borrow $1,000, I don't just have to pay back $1,000. I also have to pay back interest. So usually there's interest that you have to pay in addition to the amount that you borrowed for being able to take out that loan. So when you're going for a house, if you have a really great credit score, then you're likely to be able to get a lower interest rate, which just means in English, less money out of your pocket to repay back that house loan. Okay. So next one, stop charging and cancel unused subscriptions. So again, we live in an era now where pretty much everything, entertainment, all the things that we use are on monthly subscriptions. And so stash credit cards in a safe place and stop using them, the ones that, again, you don't need. But when it comes to subscriptions, make sure that the subscriptions that you have are things that you're actually using, because it's so often to sign up for things that you might realize that you're not even really using consistently. So it's pretty much just a waste of money. And so I know for me, in our household, we have everything. We have Netflix, Disney Plus, Amazon Prime, Hulu, we have all the stuff. And I was kind of reassessing everything. I'm like, I really only watch, actually lately, I haven't been really watching any of them unless it's like Disney Plus, if we have, our godkids over or something. And I'm like, I'm not really utilizing any of these. So I might consider, canceling some of those subscriptions. Same thing with the gym membership, right? I know so many people who are paying for gym memberships and they don't go to the gym, so why are you paying for it? That's money that's wasted, but that's also something that you run the risk of missing a payment and all those things. And so just kind of reassess the things that you're signed up for and make sure that the subscriptions you have are things that you're actually using. And if you're not using them or you're barely using them, ask yourself, is it worth the money that I'm putting into this every single month? Okay. All right, next one. So average interest rates of credit cards. So the average credit card interest rate is 16.15%. Okay, so what does that mean in English? If I go get a credit card and I use it, I don't just owe the money that I spent, I owe another 16.15% on top of that. So do you see why building up a lot of credit card debt can get you in a lot of financial stress and a lot of financial trouble? Okay, so I'm not going to read through this whole blurb, but I'm just going to pretty much summarize it to say that when you're going for a credit card, the first thing that I would recommend is try to find a credit card that's going to give you a 0% interest rate, because some banks do offer that. And so if you're able to do that, and sometimes they'll say, within your first year, you'll have a 0% interest rate. So within the first year, you could use the credit card, again, within what you can afford to help build up your credit. And then, if they start putting an interest rate on it or something like that, then you can maybe pull back and not use it as much. But that's just a quick tip that I would recommend. But you want to make sure to stay out of that, because again, that's just going to build up the debt that you owe. And I mentioned earlier that we're going to be talking about the rule of 72. So just like how the rule of 72, which again is a formula that tells you how long it will take for your money to double, depending on what kind of rate of return it's receiving, it can also work the same for your credit cards. Okay, so we'll go into that as well. So just as you can apply this rule to your interest on money, like what I just said, it can also apply on your debt. So in English, if I have $1,000 saved in an account, and let's say that I'm earning 1% interest every year, meaning that the money that I have saved every year, it's growing 1%. okay? That means, according to the rule of 72, it's going to take 72 years for my investment, my $1,000 to double, okay? 72 years if it's growing at 1%. Not very exciting, but here's the crazy thing. If that goes up to 6%, that means my money's going to double every 12 years. Now, if we're talking in terms of saving and investing money, that sounds great. But what about in the area of credit cards and interest rate? That means if you have $1,000 on your credit card and you're not making payments to it, or it's occurring a 6% interest every year, that means that that debt is going to double every 12 years that you don't pay it off. Okay. So again, that interest rate, we want it to work for us. We don't want it to work against us. So we want it to work for us in the areas of our money and our savings that we're investing to earn interest on our money. We don't want it to work. What we don't want is to use it for when we have a credit card and now there's an interest rate on that credit card on the money that we owe, and now it's going to continue to increase it. Okay. So you definitely want to make sure that you stay out of that trap. So credit card perks and rewards. Now, one of the most common things that I hear when I'm sitting down with families is that they have credit cards, A, to build up their credit, but two, because they want to utilize the perks and rewards. So a lot of you guys are probably familiar. If you know, many credit card companies, they have programs. If you use their credit card, they'll give you cash back. They'll give you air travel miles. So many credit cards partner with specific airlines and offer more generous air travel if you fly with them. And then, like I mentioned, cash back on purchases and payments. There's also introductory rate periods, purchases and transfers. So this is kind of like what I was mentioning before. Many credit cards offer a low introductory interest rate, often 0%. So cards vary as to whether they charge a different rate on balance transfers and whether balance transfers are covered by introductory rates. So what that means is if I have an old credit card debt and now I want to move that balance to a new credit card that I'm applying for. And then there's also discounts or gift cards. So different cards offer promotions that gives a gift card upon being accepted into the program. So that might be a nice little incentive. And then the last one, insurance on rental cards and card balances. Many, but not all credit cards offer insurance on rented cars if that card is used to book the rental, which is pretty awesome. It is also necessary to waive the insurance offered by the rental car company. There are some cards even offered in the same network that offer varying levels of insurance. So this is a summary of the different perks that you'll come across for using credit cards. But I'm going to say this. What happens sometimes, not all the times, is that we see these perks and what does it do? It's supposed to give you incentive to use the credit card. Does that make sense? So these companies, they put on these perks so that you use it. But again, we have to remember, and again, credit cards are not necessarily bad, but they're a moneymaker for these companies. So again, the more you use it, especially if you have something like a 16 or 18% interest rate on that, and you're paying that back, again, these companies are making money. So you just want to be very mindful. And I would recommend to do your research and find out what are the perks on the credit card, but don't, again, use that kind of like what I opened up with, use it as an excuse to use it all the time because you're getting these, incentives back. Because what can still happen is that you still end up spending way more than you would have because in your mind, you're like, well, I'm spending because I'm going to get these things back versus actually just buying what you need. So again, we really have to be careful when it comes to this because a majority of people are in credit card debt. Okay. If we look across the country, so many families have credit card debt. And again, being in debt is not fun. The number one goal that I experience from people when I sit down with them is that they want to be debt free. So we just have to make sure that we are managing our actions, managing the debt that we have, and using credit cards. Again, it's not saying that you should not use credit cards. It's not like a black and white thing, but you just got to make sure that you're mindful and be aware and do your research. Okay. So for me, and I'll give you a very, concrete example. For us, we have a credit card through Costco, okay? And so the reason why we have a credit card through Costco is not because we need it, right? We could buy it in cash, but we use our stuff at Costco because Costco gives us cash back. And we shop at Costco all the time. So that makes sense for me because I shop at Costco all the time. We use it for our business, for our home, personal items and all that. So that makes sense for me. So again, just do your research and make sure that what you're getting is going to make sense for your lifestyle. Now, credit card limits. Your credit limit is the maximum amount of money you can charge to a credit card before you face a penalty. Okay. So just because you apply for a credit card doesn't mean that it has an unlimited amount of money that you can use it for. There's always a majority of the time a credit card limit. So a credit limit may also be known as a line of credit line, or spending limit. So you could go apply for a credit card and let's say it has a $500 limit. That means that that's the most that you could charge onto the credit card. However, it is referred to the higher your credit limit, the more overall credit you have to rely on. So how do I get a higher credit limit? Beyond proving a solid or steady income, you can usually get an increase on your credit limit by raising your credit score. So the better overall credit score that you have, then the higher limit you'll be able to get when you apply for a credit card. Lenders typically set higher card limits for customers who have good or excellent credit scores. So what's considered a normal credit limit in the US? Well, limits may vary by age and location on average Americans, but on average, Americans have a total credit limit of $22,751 across all of their credit cards, according to the latest 2019 Experian data, okay? So again, it can range from anywhere from $500 up to $10,000 or more. And what usually determines what you can get is, again, your income, how much income you have, what you know is coming into the household, and then also your credit score. So credit inquiries. So again, going back to that question that I saw pop up in the beginning. So there are two types of credit inquiries. There are, and they're treated differently when it comes to your credit score. So inquiries that are made because of an application you've made are known as hard inquiries. These are the only credit inquiries that count towards your credit score. For example, an inquiry made when you apply for a credit card or loan will appear on your credit report and can affect your credit score, okay? So in reviewing your credit report, you might notice that several inquiries appear from businesses to which you didn't apply for credit. These are often from businesses who've checked your credit report because they want to offer goods and services to you. For example, creditors who send pre-approved credit card offers, right? We probably get that in the mail all the time. Checked your credit report first to see if you meet the basic criteria for the credit card. These soft inquiries count towards your credit score. So credit inquiries are also made by potential employers, businesses that you already have credit with, and yourself. These are also soft inquiries and won't hurt you. And then inquiries on your credit report are one of the ways credit scoring companies gauge the risk that you'll default on new credit obligations. Too many inquiries, especially in the past few months, might mean that you're taking on too much debt, or that you're in some kind of financial trouble and are looking for credit to help you out. So several inquiries can lower your credit score. So again, the hard inquiries, which happens when you're applying for different things, again, that can negatively affect you if you're doing it a bunch of times, because again, if someone is looking at that, they see that, okay, so they're trying to apply for all these loans, is because they need money and different things like that. So that is a little summary on those things. So check out the websites of the top credit reporting agencies for pointers to improve your score and report errors. So look for the word dispute. So these are the three companies where you can go to pull up your credit score: transunion.com, experian.com, and equifax.com, okay? And so it's always good to take a look at these because you want to make sure that, everything looks good. There's nothing on your credit score that, let's say, you didn't apply for, so, you could stay on top of that stuff. And, but again, this is where you'll be able to pull up that information and see what your credit score looks like. And then know what you owe. So once a year, pull your credit report from a free online service. Make sure it's accurate. So by law, every American citizen has the right to a free credit report every 12 months. So avoid free report websites, as they will wind up charging you money. In response to the law, the top 3 credit reporting companies provide free reports at annualcreditreport.com. So there you go. That's a good one. And then I know I use Credit Karma as well. Credit Karma is a big popular one that helps you keep track of your credit score. So that is a good one as well. Okay, so we talked a lot about credit, and now I'm actually going to finish it off with the last thing that I said. So I hope that I know I kind of went through a lot of information, but we will have some Q&A at the end again. So if you had some more questions, I'm sure there were some questions popping up in the chat that you wanted to get answered regarding that. We'll do that in just a couple more minutes. But before I turn it back over to Paul, I did want to again touch on this, taxes, because taxes have a huge impact when it comes to saving money and putting money away for your future. And so a lot of what we've been talking about in this series is just, you know, making sure that you're budgeting properly, that you're paying yourself first, which just means saving money and different things like that. So now when it comes to thinking about your future and thinking about long-term, again, taxes play a major, major impact on the money that you save. So if you're currently working, you know that when you receive a paycheck from a job, you know, you're not getting the total amount. What do you see come out? You see state taxes come out, you see federal taxes come out. And so when it comes to saving money, there's 3 different kinds of taxes that you're gonna pay on that money that you put away and invest. There's taxable accounts, tax deferred accounts, and tax advantaged accounts, okay? So taxable accounts, those are accounts that are taxed annually. You also pay capital gains tax on that money, which just means that every time your money grows, you pay taxes on the gains that you get, the interest that your money grows. So different examples of taxable accounts would be savings account at the bank, mutual funds, stocks, different things like that. All you need to know is that all those things, what they all have in common is that they're all liquid accounts, okay? Liquid means that you have access to it. You could pull the money out whenever you want to. So what I always recommend to people that I sit with is that you want to have some of your money here. This is where you want to have your emergency fund. We talked about that in one of the last seminars, you know, having at least about 3 months of your monthly income in an emergency fund. This is where you also want to have, you know, your, if you have a goal, like a short-term goal, maybe in the next 2 years, you want to take a big trip or something like that, and you're saving money for that, you want to make sure that you're saving it in something over here because you want that money to be accessible because you're going to be pulling it out pretty quickly. But that's not where you want to have all your money. Then we move into tax deferred. So tax deferred is where you find any kind of retirement account. So when you start working full time, your employer is probably going to offer you a 401k or a 403b. All that means is that that is a retirement account that you're able to contribute to save money specifically for your retirement. So with a tax deferred account, what that means is that as you're putting money into your 401k, the money going into it is going in tax free. But then when you're ready to retire and pull out the money, that's when you're going to be taxed. Now, I know for me, prior to what I do now, I actually used to have a full-time job with the County of Los Angeles as a social worker. And I remember when I was there, I had a 401k as well. And, you know, I signed up for my 401k, but no one really explained to me that this was a tax deferred account. I didn't realize that the money I was putting in my 401k was going to be taxed later when I wanted to actually pull it out and use it. Now, it's not to say that that's necessarily a bad thing, but that's just something that we need to be aware of. So understanding that you're going to pay a lot of taxes on that money later on when you want to use it means that you probably shouldn't just rely on that for your retirement and for your future savings. And then we have tax advantaged accounts. So with tax advantaged accounts, instead of getting taxed later after your money grew and got to where it's at, in a tax advantaged account, the money going in was already taxed because it came from your paycheck. But once it goes into this account and it grows and grows and grows and grows, you're able to pull the money out tax free. Okay. So there is a place for every single one of these, but the key is that you want to be diversified. You don't want to just have all your money in one place. Okay. It's important to have your short-term savings, like a savings account. It's important to have, your 401k at your job. If they offer that, start putting money away into it. But it's also important to have some tax-free money as well, because that plays a huge impact. So that is about it on my end. So I hope you guys got some value, and thank you guys for your time.
Thank you, Kirsten, for the outstanding work that you've done here today. And here's what I'd like to say to everyone as we wrap this up and as we conclude today. I know that you're excited about getting this information for the purposes of the scholarship, which I'm so grateful to New Vision for putting on for you again this year, which is phenomenal. Uh, but what I'd say is apply these principles to your everyday life and your current circumstances. If you can take a little bit from each one of the seminars that Kirsten presented, then I'm sure that you will gain inches, and one day you'll need a telescope to see how far you've come in your financial life. We appreciate you. Thank you for being on with us. Thanks to New Vision. Thanks to the team that put this all together. And thanks to each and every one of you who took the time to watch with us. Go to sachallenge.com to apply for the scholarship. Be well. We'll see you soon. Bye-bye, everyone.